Welcome back to my channel, where we track the latest threats to your financial future. Today, we're facing a perfect storm. Literally. Hurricane Milton, a Category 4 monster, is barreling toward Florida's west coast. But Milton is more than just a weather event. It could deliver a blow to an already fragile American economy. In this video, we'll break down exactly why Milton may be the final tipping point that plunges the U.S. into deeper financial turmoil. Florida's economy, one of the largest in the U.S., could be crippled by Milton's path of destruction. Cities like Tampa are already bracing for 15-foot storm surges, and this comes just weeks after Hurricane Helene battered the region. As infrastructure collapses and businesses are forced to shut down, the economic impact is set to ripple far beyond the state. In fact, some analysts are warning that Milton could trigger economic losses that mirror the aftermath of Hurricane Katrina, one of the costliest storms in U.S. history. Let's start by looking at three critical sectors that drive Florida's economy: tourism, real estate asterisk, and agriculture. These industries aren't just vulnerable to Hurricane Milton, they could be devastated beyond recovery. Tourism accounts for a huge portion of Florida's economy, with cities like Orlando and Miami drawing millions of visitors each year. But Milton's arrival has already forced the closure of major theme parks, including Disney World, Universal Studios, and SeaWorld. Analysts estimate that Disney alone could lose between $150 million and $200 million from these closures. Keep in mind that the broader impact on Florida's hospitality industry, hotels, restaurants, and transportation, could easily push the total economic hit into the billions. Next, we have real estate. Florida's property market is booming, especially along its flood-prone coastline, but Milton could bring that to a screeching halt. Some areas of Tampa Bay have not faced a direct hurricane hit in over 100 years, but Milton, with its 15-foot storm surges, is poised to flood residential and commercial properties, leading to long-term damage. What makes this worse is the fact that Hurricane Helene recently flooded the same region, leaving debris that Milton's winds will turn into dangerous projectiles. The cost of rebuilding damaged homes and infrastructure could send shockwaves through the real estate sector, potentially triggering a housing market downturn in Florida. Lastly, Florida's agriculture industry, which is heavily reliant on its citrus crops, is also in peril. The state supplies the majority of the country's oranges, but the high winds and flooding brought by Hurricane Milton could devastate groves. Citrus production could drop dramatically, driving up the price of goods like orange juice across the nation. Such a hit to agriculture could have lasting consequences on the supply chain and the national inflation rate. Now, let's talk about the insurance sector. Florida is no stranger to hurricanes, but back-to-back storms like Helene and Milton are pushing the industry to its breaking point. Insurance companies are already struggling to keep up with claims from the previous storm, and Milton is expected to add tens of billions more in damages. The result? Many insurance companies could face liquidity issues, driving up premiums for homeowners across the state, and even causing smaller companies to collapse under the weight of claims. This rise in premiums won't just impact Floridians. It will likely ripple across the nation, affecting insurance markets and driving up costs for property insurance in other coastal states. As insurance companies struggle to pay out claims, their stock prices could drop significantly, dragging down the broader financial markets. The energy sector will also take a hit. Oil production in the Gulf of Mexico may avoid direct damage from Milton, but coastal energy facilities and electric grids in Florida could be severely disrupted. Power outages, gas shortages, and damaged energy infrastructure will increase costs for both businesses and consumers. In past hurricanes, we've seen gas prices rise due to disruptions, and there's no reason to expect this time will be any different. So far, we've seen how Hurricane Milton will directly impact Florida's economy, but the bigger question is, how will the markets react? As investors start to assess the full scope of the damage, there's likely to be a sell-off in vulnerable sectors like tourism, real estate, and insurance. But the risks don't stop there. As we move from the immediate economic effects in Florida, the larger question looms. What will this mean for the financial markets? Historically, natural disasters of this magnitude have had ripple effects across various markets. While localized disasters primarily affect the region they strike, a storm like Hurricane Milton, which threatens one of the largest state economies in the U.S., could send shockwaves through national and even global markets. Let's look at some past examples. When Hurricane Katrina hit in 2005, it caused over $161 billion in damage, leading to a sharp decline in U.S. economic growth in the following quarters. The stock market tends to react strongly to these events, particularly in sectors tied to the affected regions. With Milton, we expect to see a significant decline in stocks related to tourism, insurance, and real estate, all of which are heavily tied to Florida's economy. The broader market reaction typically happens in waves. 1. Immediate sell-offs in sectors directly impacted by the storm: tourism, insurance, real estate. 2. Volatility in the days following as investors assess the full extent of the damage. 3. A potential rally in certain recovery-focused industries such as construction and energy as rebuilding efforts begin. In the case of Hurricane Harvey, 2017, oil prices spiked due to supply disruptions in Texas, but insurance stocks tumbled. For Hurricane Milton, we could see similar movements. Energy prices may increase due to infrastructure damage, while insurance companies are likely to see sharp declines in stock prices as they are hit with massive claims. Now, let's break down how Hurricane Milton will affect the most vulnerable sectors in more detail. First, real estate. Florida's real estate market, particularly in the Tampa Bay area, is facing one of its biggest threats in decades. With over 500,000 homes at risk from the storm surges, the real estate sector could see prolonged damage. Investors holding REITs tied to Florida's property market should brace for a possible downturn. Real estate investment trusts with a heavy focus on coastal properties will likely experience short-term devaluation as home prices drop, and repairs flood the market with costs that may take years to recover from. Next, the banking sector could be indirectly hit by Milton's real estate damage. Banks with significant mortgage portfolios in Florida are at risk of defaulted loans and devalued assets. Florida homeowners facing property damage might default on loans or opt for forbearance programs, weakening banks' financial positions. Additionally, agriculture will not be spared. Florida produces a significant portion of the country's citrus supply, and Milton's strong winds and floodwaters are expected to cause major losses in citrus groves. This will likely cause a spike in citrus prices nationwide, affecting consumer prices and adding fuel to inflationary pressures. The agricultural damage might seem isolated, but disruptions to crops like oranges and grapefruit could have national consequences, similar to how disruptions in Texas oil production impacted gas prices during Hurricane Harvey. This brings us to one of the most critical points: inflation and interest rates. As the U.S. is already struggling with high inflation, Hurricane Milton could worsen this problem. The supply chain disruptions caused by infrastructure damage, particularly in construction materials and agricultural products, will likely push prices higher. Consumers may see spikes in the cost of groceries, building materials, and even fuel as logistical delays and shortages create bottlenecks. When a disaster like this strikes, the Federal Reserve is faced with difficult choices. On one hand, they need to keep inflation under control, which would traditionally lead to interest rate hike. However, increasing rates in a post-disaster scenario could further strain the economy, especially as businesses struggle to recover. Following Hurricane Katrina, for example, the Fed had to weigh the potential inflationary effects of reconstruction costs against the overall need for economic stabilization. We may see the Fed walk a similar tightrope post-Milton. If inflation worsens and rebuilding efforts are delayed, the Fed could be forced into a corner, needing to increase rates to curb inflation at a time when the economy needs stimulus for recovery. This could lead to a stagflation-like scenario, rising inflation paired with a slowing economy, a worst-case outcome that would spell trouble for the broader market. Lastly, we can't ignore the global repercussions of Hurricane Milton. The U.S. economy is deeply interconnected with global markets, and any major disruption can cause ripple effects worldwide. With Florida being a key hub for trade, port disruptions could delay goods not just for the U.S. market, but for international partners who rely on exports and imports passing through Florida's ports. Global investors are already wary of the uncertain U.S. economy, given the ongoing inflation and interest rate challenges. Hurricane Milton could further erode investor confidence in the U.S. market, especially for foreign investors who are heavily exposed to U.S. real estate and insurance companies. If international investors begin to pull out, it could lead to capital outflows, weakening the U.S. dollar and putting additional pressure on global markets. In the aftermath of disasters like Hurricane Sandy, global markets initially saw sharp declines, followed by slow recoveries. We can expect something similar with Hurricane Milton. though the impact may be more severe given the current economic climate. As Hurricane Milton barrels through the heart of Florida, causing widespread destruction, the question now is, how can you, as an investor, protect your finances? The immediate concern is how the markets will react in the coming weeks, and more importantly, how you can reposition your portfolio to weather the storm. When natural disasters like Milton hit, there are always clear winners and losers in the market. To protect your assets, it's time to consider moving your investments into safe haven assets. These are typically assets that are less volatile and more resistant to market swings caused by natural disasters or broader economic shocks. Bonds are the first to come to mind, particularly U.S. Treasury bonds, which tend to hold their value or even increase as investors seek stability during turbulent times. For those looking for further diversification, gold has long been considered a hedge against both inflation and uncertainty. As inflation pressures rise, fueled by supply chain disruptions, price spikes in goods, and increased reconstruction costs, gold could act as a store of value. Historically, when the markets experience fear, gold prices tend to rise. Commodities like gold or even silver could provide a cushion in the face of stock market volatility driven by Milton's aftermath. Additionally, there are opportunities in infrastructure stocks. Companies involved in construction materials, machinery, and rebuilding efforts often see gains after such disasters, as government funds and insurance claims begin pouring into affected regions. Keeping an eye on stocks linked to construction and logistics might offer growth opportunities as rebuilding efforts get underway. The insurance market is about to face one of its greatest tests, with Hurricane Milton triggering what analysts predict could be tens of billions in insured losses. Insurance companies are bracing for a flood of claims. For many investors, this represents a significant risk in insurance stocks. Historically, after hurricanes like Katrina or Sandy, insurance companies took substantial hits as they processed massive claims, which led to stock devaluations and higher premiums. For the average policyholder, this will likely result in an increase in home insurance premiums across the country, particularly in disaster-prone areas. Insurance companies will need to recoup their losses, which means higher costs for consumers. At the same time, investors holding insurance stocks should be cautious. While some of the larger, diversified insurance companies may weather the storm, smaller insurers, or those with high exposure to Florida's real estate market, could be facing bankruptcy risks. Investors may want to avoid or minimize exposure to these stocks until the full extent of Milton's damage is clearer. However, in the long term, insurance companies that survive will inevitably adjust their business models, increasing rates and tightening underwriting policies. This shift could create new opportunities for those looking to invest in a recovery cycle within the insurance sector, particularly after the initial shock has passed. Beyond the immediate impacts on real estate, tourism, and insurance, Hurricane Milton is likely to have profound long-term effects on the American economy. The most obvious will be the rising costs of rebuilding. Just as we saw after Hurricane Katrina, the long process of rebuilding homes, roads, and infrastructure will increase the demand for construction materials, labor, and logistics. But this comes at a cost: inflation. The price of materials like lumber, concrete, and steel is likely to skyrocket, pushing overall inflation higher. In the months following the hurricane, Florida's economy could struggle to regain its footing, especially as key industries like tourism and real estate take longer to recover. With thousands of jobs potentially lost in these sectors, consumer spending could drop sharply, contributing to slower economic growth. There's also the potential for increased government debt. The federal government will undoubtedly step in with disaster relief funds, but as we saw with Hurricane Harvey and Katrina, these relief packages often come with a hefty price tag, adding to the national debt. If the Federal Reserve continues to raise interest rates in an effort to combat inflation, it could further stifle economic growth, leading to a stagflation-like scenario, where both inflation and unemployment rise at the same time. As we've seen, Hurricane Milton represents far more than just a natural disaster. It's a financial event that could have lasting impacts on markets, inflation, and the overall economy. The key takeaway for investors is to remain cautious and diversify. Moving into safe haven assets, reassessing exposure to vulnerable sectors like real estate and insurance, and looking for opportunities in infrastructure and commodities could help protect your portfolio. In times like these, it's important to stay ahead of the market shifts. Keep an eye on the Federal Reserve's next moves, monitor inflation data closely, and watch for signs of volatility in the markets as the true extent of Milton's damage becomes clearer. By acting now, you can mitigate risks and position yourself for long-term stability in these uncertain times. Please don't forget to like this video and subscribe to our channel to stay updated. Until next time.